For many people, filing a tax return feels like flipping a coin. Some years they win with a big tax refund. Some years they lose and have to write a big check to the IRS in April. Wouldn't it be nicer to take control of the game, tipping the odds in your favor, and knowing what to expect every year? Strategic tax planning can give you that control. This video explains what tax planning is and how it differs from basic tax preparation. It will introduce you to strategies that can reduce your tax bill not just for a year, but for a lifetime. Let's get started by clarifying a couple of key terms you need to know. The phrase tax preparation refers to the process of completing and filing a tax return. The most important thing to know about this process is that it looks backward. Almost every aspect of preparing a tax return relates to things that already happened during the previous year. So when tax preparation services brag about getting you the largest possible refund, it's critical to understand the limits of that promise. Tax return preparers can help ensure that you do not make mistakes like neglecting to claim a deduction or tax credit that you qualify for, or failing to report taxable income. And those things certainly could save you money by ensuring that you don't overpay in tax and also stay clear of IRS penalties. However, the factors that really determine the amount of your tax refund or tax bill are all baked in by the time filing season arrives, resulting from decisions made months or even years ago. In essence, the coin has already been flipped before the tax preparation process even begins. By contrast, tax planning involves looking ahead, anticipating possible outcomes, and making decisions while there is still a chance to change those outcomes. Perhaps a major tax-saving opportunity, like a large credit or deduction, lies just around the corner, but you will only be able to claim it if you take certain steps today. Or maybe an impending boost to your income could result in a big jump in your tax bill, but you have ways to mitigate that impact if you plan ahead. In short, tax planning has two primary components: anticipating the potential tax impacts of a wide variety of events, and deciding which actions will enable you to make the most of tax-saving opportunities and minimize the impact of factors that could increase your tax. Let's first look at some of the main elements of tax planning for a single year, then talk about why the most effective tax planning actually spans multiple years. Dozens of different life events could affect your taxes for a given year. These events may include earned income changes due to a raise, promotion, job change, loss of job, taking up a freelance side hustle, and so on. Unearned income changes, such as an increase in rental income or investment returns like interest and dividends. Marriage or divorce. A change in your family size, such as the birth or adoption of a child. Children growing up so that they may no longer qualify as your dependents or as your qualifying children for tax credits like the child tax credit or earned income tax credit. Moving, selling your home, or buying a new home with a mortgage. Making energy efficiency or clean energy improvements to your home. A household member pursuing higher education, and many, many more. When considering tax strategies for the current year, think also about how things turned out when you filed your last tax return. If you owed a significant amount of tax, you will want to avoid ending up in that same situation next spring. And while it may be exciting to receive a massive tax refund, that refund actually tells you that you overpaid in tax throughout the previous year. Most likely, this occurred because too much tax was withheld from your paychecks. As a result, the government earned interest on your money instead of you. Any of these life events or tax circumstances might mean it's time for you to adjust your paycheck withholding. The IRS provides a pretty handy tool for this purpose called the Withholding Estimator. You'll find a link to that tool in the resources section of this website. If you do not have taxes withheld from your income, for example because you work as an independent contractor, then you may need to adjust your estimated tax payments instead.